Ever since mutual funds were launched in India, there has been a steady increase in the number of funds. Post-COVID, many such companies have emerged, and as of now, around 45 AMCs are accounting for 1,453 different mutual fund schemes. This has made investing easy for new generation. It also leaves novice investor confused with so many options available before them. While there are tons of information on the web on how to invest and how to choose mutual funds, it is hard to find a content on the topic how not to pick a fund. In this video, we will take a deep dive into some counterintuitive pointers regarding mutual fund selection. Welcome to holisticinvestment.in. The first point is ratings. We rely on star ratings for almost everything in our lives, isn't it? Whether it's choosing a hotel, restaurant, a service. Ratings makes our decision easier, right? We trust these ratings and accompanying reviews. This is true to a certain extent, but the same analogy cannot be applied when we choose a mutual fund. These star ratings are created mostly based on past returns, drawdowns, alpha generation, and the time ever since the inception of these funds. Now let us see what happens if you invest based on the star rating. In the initial years, the chosen funds outperform all the fund and turns out to be a great compounder. Suddenly everything takes a U-turn and the ratings are downgraded from 5 star to 3 stars. Now two things can happen. Either option A, you choose to stop investing in the fund and continue to hold it in your portfolio, and you start investing in another fund. When you do this multiple times, you will end up with a cluttered portfolio containing many different schemes. Or else, option B, you choose to dispose of this fund and exit it. Here you may incur long-term capital gain and the real wealth building doesn't take place. The beauty of mutual fund is compounding effect, which doesn't happen in this case. In essence, while star ratings can provide a quick snapshot of mutual funds performance, they don't tell the whole story. Next, historic returns. Past performance is no guarantee of future returns. Please read the offer documents carefully before investing. You would have seen the above lines in all mutual fund fact sheet under the disclaimer, right? Well, they aren't disclaimers, they are fundamental truths. The world is rapidly changing and so are the markets. There was once a time when the USA and China were considered to grow faster, but now there is a paradigm shift and all the investors are bullish on India. When the world changes, how can a fund remain unchanged and deliver the same returns? When investors like you see a fund that has been consistently delivering high returns, they tend to jump in, hoping to ride the wave of success. Unfortunately, by the time you make a move, the fund may have already reached its peak. This means that we are entering the fund at a time when it's more likely to experience a downturn or a period of lower performance. And this is the law of mean reversion. What goes up must eventually come down. Okay, so now we are aware of how to not select the fund based on the previous return. But what should be the ideal way to choose? Consistency. Yes, choose a fund that is consistent and showing gradual improvement. It is better to have a fund that is growing rather than having a fund with a return like 2 years negative returns and after that positive return and again 1 year negative return. Avoid volatile funds. Next, branding. Do you love branded items? Right from our accessories to the appliances in our home, we always go for branded ones only. The reasons are trust, durability, and guaranteed performance over time. But is this the same with investing as well? The answer is both a yes and a no. A good brand name doesn't necessarily mean it is the right choice for our money. While brand-driven investing has its merits, it's not a one-size-fits-all approach. Trust in a brand is a valuable factor, but it should be just one of many considerations. A big brand might have a solid reputation on one side of the spectrum, but could stumble when it comes to new avenues. Just because they are famous for something else doesn't guarantee expertise in managing your money effectively. Look beyond the brand label and well into the specifics of the fund. Assess their performance, strategy, risk profile, and alignment with your financial goals. Next, impact of influences. This is the most common mistakes amongst novice investors. Seeking advice from family, friends, and influences from social media and act according to that. We do not know who these influences are as they are fairly unknown to commoners. Though their content may be promising, whatever they invest may not suit us. We as individual investors may be limited to a certain degree of risk, unlike the influencers who may have high risk appetite. They may have the capability to take on risks that may not apply to us. There are no concern in checking with friends and families for your investment advice on which mutual fund to invest in. But the final decision to invest should be yours. After all, it's your money that is at stake. We cannot rely on friends and relatives or any other influencers investment advice, as what is best suited for them may not be best suited for us. When you invest in any financial product for that matter, it is necessary to assess your needs, investment objective, risk profile, and financial goals you are addressing and take wise action. Next is net asset value, NAV. In stock, the common methodology is to buy low and sell high. Is a mutual fund with a NAV of 15 preferred over another fund with a NAV of 50 in the same category? No. The value or pricing structure for stock is purely determined by market demand. A mutual fund's worth, on the other hand, is decided by how much money is invested in it, as well as the cost of running it and the number of outstanding securities. NAV is not a parameter. NAV is merely the per unit market value of all securities held by mutual fund minus its liabilities divided by the total number of units outstanding. It is essentially the price at which investors buy or sell mutual fund units. Your purchase NAV is taken as a base for calculating the appreciation or returns. The appreciation happens not because of low NAV or high NAV. Appreciation happens because of the underlying portfolio and the ability of the fund manager. So we should check the other parameters like funds composition, funds performance history, asset allocation, and management strategy. Next, is it wise to invest in thematic or sectoral funds? These are the types of mutual funds dedicated to investing in a specific sector or theme. Sectoral funds focus on companies within a particular industry such as banking, information technology, or healthcare. These funds offer very high returns but also offer a great risk to the investors. The trade-off between risk and reward is slightly tilted towards the risk side, as the chance of the fund to underperform is higher. The primary goal of investing is to grow your capital through well-performing funds while also protecting your investments. Choosing thematic funds demands diligent monitoring and thorough research. The best decision is to stay away from these funds till you gain expertise and are willing to bet your money. So far, we discussed how not to select a mutual fund. The idea of identifying the best mutual fund is a misconception because there is no absolute best mutual funds. This is primarily because a mutual fund's current strong performance doesn't assure it will maintain the same performance or deliver exceptional returns in the future. The same goes the other way as well. A worst performing mutual fund may have a turnaround and may outperform the market. So it is essential to keep a constant check on the fundamentals and not make the mistakes that we have discussed in the video. Do not go by the words of influencers and do not blindly follow the mutual fund related posts on social media, as they may be biased and may not paint a true picture. Please refrain from following bad advice and wasting your hard-earned money. Consult a professional financial planner to avoid pitfalls in your investment journey. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.